and I appreciate you coming to visit with us tonight and learn about the Grassdale webinar. This is an investment opportunity that we're offering for accredited investors, and it's through a opportunity zone. So I'm glad that you joined. I expect to have about maybe 45 minutes of presentation, including some question and answers, and we're going to cover a couple of different topics. So that's kind of what you can expect and anticipate tonight. So let's go right into tonight's presentation. On your screen, you should be able to see you should be seeing my screen shared with you, and the title of that should be Grassdale webinar with today's date on it. All right, introduction. For you that don't know me, my name is Lane Bean. I'm one of the founding members of Pilot Legacy Private Equity Group, and I've got with us several people tonight that I'm just going to make mention of now, and I'd like for them throughout tonight's presentation to add any comments or any things that I may have missed. One of our other leadership team, and I'll just introduce them, is Michael Walker. He's with us attending tonight. Edwin Sosa is with us as well. Rich Lowe and also Rodolfo Martinez is with us as well. So they'll be on the call tonight with us if we have any question that we can ask. Also, I always like to say that if you're the smartest person in the room, you're in the wrong room. And I'm lucky tonight to have these guys on my team because they're definitely smarter in each area than I am. And I'm going to be asking them throughout tonight's presentation to chime in with things I may have missed, or also with comments that I didn't include. And feel free to ask them directly, or I'll defer to them because they have certain levels of expertise. But that's the management team for our program, and that's the management team that's on tonight's call. Here's what we're going to talk about, and it's going to cover about 45 minutes, broken out into several different subtopics. And I'd like to give you these as we go through this. I'm going to go through the introduction, which we've done. We're going to talk about the investment strategy behind our project. We're going to talk about the market analysis, the property analysis, and then the team. At the end of each segment, I'm going to ask for any questions that you may have concerning this particular subject, and we can get through that. If by the end of tonight's presentation and we complete with team, if you still have some questions, there will be a question and answer period at that time as well. But if there's something specific that could be addressed by a certain slide, then by all means, just either sing out, take yourself off of mute and ask me, or you can ask me at the end of tonight's presentation also. Right. Investment strategy. Here's what we're trying to do with our project in Maynard. Okay, and I'll give you a second to read that. But basically, we're going to develop a 320 unit multifamily community serving the naturally affordable housing market in the city of Maynard, Texas. We're going to hold that property for 10 years and capture the full opportunity zone. That's our objective. So that's the strategy that we're trying to execute. And let's talk real briefly about opportunity zones and how they can benefit the investors. This is a depiction of Central Texas, and you see over in the left, we've got San Antonio. Up in the north portion of our map, we have Austin, and then we have Houston. This is one of the fastest growing areas of Texas, as you well know, and one of the better markets. What I've got indicated here in the blue is the qualified opportunity zones, and each one has been designated according to a census tract, and those are those blackened numbers that you see inside of the blue colored census tracts. The governor of Texas identified each of those areas as either one, economically depressed areas that are in need of revitalization or areas that need recapitalization. And you can see in the area that's over from the left of the map to the right, there's a couple of areas to the south of San Antonio. And then as you move north along I-35, you can see the development areas around Austin. I'm going to make my mouse here show you just to show you where Maynard is relative to Austin. And if you can see my mouse there circling Austin, Maynard is this just to the east of this intersection between Highway 290 and Highway 130. So this is the area of Maynard, and our property site is right underneath my cursors. You can see this area of a lot of traffic between San Antonio and Houston and Austin runs right across Maynard, and it's in a very good populated area. That's the qualified opportunity zone. There's a lot of benefit to these areas, and we'll go over that a little bit more in slight detail. If there's any questions specifically, then it may be best just to ask me, or I can direct you to the web videos that we have already produced on how that can benefit you. But we really feel like this opportunity zone paired with a good investment strategy and a good investment location is one of the very best real estate incentives and tax incentives of all this decade. So that's where we're looking, and that's the map. Let's drill down a little bit more into the sub area of Austin, and let's take a look at Maynard and what Maynard is. Okay, so back to the Austin area, which is a drill down. Okay, so in the bottom left, you've got Austin. This is downtown Austin as a reference. You've got the University of Texas at Austin right here. So this is a very, very dense area of Austin with a large population. You got I-35 leading out north to the city, and then you can see the connection here to Highway 290, okay, and then it comes across into the city of Maynard, or the community of Maynard. From a straight line from Maynard to Austin, it's a 10-mile commute, and then along this major intersection, that's about just a little over 12 miles, all right? This portion of Highway 290 is a tollway that was added, and then this section here is State Highway 130, which is also a tollway, okay, leading into Maynard. The site that we have is identified just to the east of Maynard, the community, and I'll show you that in just 1 second. And our site is indicated by this red plot. This is the city, or this is the federal census number that associates this tract, and that census number was identified by the governor of Texas as a qualified opportunity zone. And I'll bring that out because as an investor, the requirements for what you need to do to certify cooperation or participation in a qualified opportunity zone is a one form on your IRS tax report, and you need to identify this number, and that number associates with our project, and that's pretty much the limits of your investor requirements. So I make that point just to show you that this is a very easy investor qualification to get credit for the opportunity zones. That's Maynard for us. So let's take a look at the next slide and look at the Grassdale project. Okay, 320 units constructed Grassdale in Maynard, Texas, coupled with an opportunity zone. This is the concept elevation of what the project's going to look like. And I'll go over a little bit more of the story behind this, but our idea is to incorporate the story of Maynard into the architectural design and get a Texas apartment complex, if you can imagine such a thing. And as the architect put this concept together, I thought they did a really nice job of capturing many of the elements that represent Texas and many other elements that I think will fit in very nicely with the Grassdale project in Maynard. Before I go to the next slide, I'd like to talk just a little bit about an opportunity zone and just spend a minute or two to explain what this opportunity zone incentives are. And I'm going to tell you a little story that helps me understand this. If your closet is like mine, there's probably 20 shirts in your closet that are hanging in your closet, but you may only wear about 5. The other 15 are either out of fashion, they're no longer fitting you, or they're just worn out. And it's really probably a smart idea to upgrade those. Well, that's a lot like this concept of opportunity zones, because the government has given you an incentive now to upgrade your closet, or in this case, upgrade your financial portfolio and get rid of those investments that no longer are in style, no longer are fashionable, or no longer fit you well. And so that's why the government has done that. And one other quick story to kind of help you understand an opportunity zone is, imagine that you and I went to lunch today, and I bought you a $10 sandwich, and I said, hey, you've got to pay me back, but you only have to pay me back $8.50, and you need to pay me back in 7 years from now. So that would be a good lunch for you, coupled with upgrading those worn out shirts. If you understand those two principles, then you have a pretty good feel for what an opportunity zone is, except for instead of shirts, you're talking about your investments and a chance now where the government will incentivize you to get rid of those languished stocks, those underperforming assets, and upgrade that into a better fitting shirt, a better, more capable, or more current strategy. And that's what this project holds for you. So that was just a real quick explanation of our strategy. And it was a real quick explanation of an opportunity zone. There's quite a bit more to talk about, and you can find more information with very specific details on our website, and our website's pilotlegacy.com, or you can contact me and I'll be glad to answer that question for you. Okay, that's the strategy. Now let's talk about the project timeline. This is a development project, and what you see here is a current map, our current calendar, with each phase of project broken down in color indicated. So right now we're in 2019. We just turned into April, okay? And you can see we've started our campaign, our capital campaign, and trying to raise funds to complete this project. We're gonna close the land right around the middle of May is our projected close point, and that's a purchase price of $2.85 million, and we'll have some closing costs with that. So we're anticipating that that will be about $3.5 million, and that will be a portion of our $15 million. Once we get to our $15 million capital campaign, then our fund is closed, okay? So as far as the conceptual phase, the conceptual drawings, the feasibility study, that's all been in the works and continues. As we go from April to May, we're going to get into the construction documents, the land entitlement, and all of the requirements, working with our financier. And that process is going to take us pretty much right up until the construction beginning, which is right around the end of November is what we currently have scheduled. Once we have the land closed, we have the design phase in the works. We're working with the city to make sure our plan has been approved. Then we're going to go into the pre-construction phase, which will include site development, utility layout, surveys, other engineering studies to ensure that our contract or ensure that our construction documents are finalized, and we'll be ready to break ground and turn shovels in the beginning portion of the mid portion of November and the beginning portion of December. That's going to be about a 24-month project, okay, that will start to show immediate development, and we're going to get the first units and the clubhouse developed at about the 1 year point. So about 1 year from breaking ground in November is where we will get to the first units. And then after that, they will come in lots by building, and we'll be building from the north part of the project down to the south. And we expect all the projects to be complete in 24 months from the start of November, okay? So that's kind of the timeline of where we are on the construction portion. And let's talk a little bit about subscriptions, okay? I've already told you that we're raising capital currently, okay? And we need to have 3.5 million available at the middle of May, all right? And we've got that secured, confident that that's going to happen. And if we subtract that number off of this number, we'll have 11.5, okay, left to close. All right, so I bring that up for one reason, is because this timeline is important for us to close, one, the land, and then the construction cost, okay? And once we get to 15 million, the fund closes. And I bring that up because this investment is really optimized for the reinvestment of capital gains. And I know that some of the investors that are listening tonight may have some stocks, bonds, that they are intending to sell or some real estate acquisition, the real estate projects that they are also intending to sell. And so I want to make sure that you understand that we need either if you want to sell and you're making efforts to sell those, then we want to include you, if we can, into this fund closing. So I need to be speaking with you if you're planning to sell stocks and bonds or real estate, so that I can reserve a spot in this fund for you. Because once we get to 15 million, I would hate to have you sell an asset and then you say, Lane, I'm ready to invest, but not knowing that once we get to 15, then that's going to be closed. So that's the emphasis that I want you to understand is, hey, invest now with us, or make sure you communicate early your pledge so that we can hold money at your suspense point to make sure that you sell that asset and then subsequently do not have to pay a capital gain if that was your intent. All right? So I want to make sure that is clear. One other point, and then I'm going to stop for some questions because I think this is a very important slide, is let's say that you invest with us from day one. Well, your funds begin to incur immediately a 6% preferred return from the day of your investment. But you'll see that we don't have the first units and the first rent payer for almost an entire year, or depending on where you come in at this point. But your 6% return continues to accrue until we get cash flow, and then until that cash flow pays you back for each period that you've held the project. Then that's when the profit sharing proceeds begin to kick in. So your dollar figure will accrue, or your preferred return will accrue from the day of your investment. Okay, I think this is a very important slide, and I would like to just stop here for just 1 second before I go on to the next one, in case there's any questions, or Michael or any of the other managing partners would like to mention something that I haven't already mentioned. So about 20 seconds or so. If you have any question, then take yourself off mute and please ask me. Michael, did I miss anything that you would like to add? Rich, did I miss anything?
I think you've got it.
Hi, Lane.
Rich, did I miss anything that you'd like to add up to this point?
No, so far so good.
Okay, Edwin, anything? Rodolfo, anything that you'd like to add? Okay, very good. So that's the timeline and the investor contribution schedule. Again,
Lane?
just come up.
Sorry, Lane, can you hear me?
Yes.
Who on your team has experience in the construction phase of apartments?
Yeah,
I know you guys have a lot of experience in older stuff and remodel and that kind of thing, but what about construction?
Yeah, that's a great question. So let me just real quickly touch on that, and then I'm going to come back and cover that in adequate detail in the team portion of it at the very end. But Michael has got 4 projects that he has completed with Callaway Architect, which is our architect that we're building with. And those projects are a 240-unit complex in Mesquite, a 264-unit complex in Fort Worth, a 164-unit complex in Benbrook, Texas, and then 104 in Carrollton, Texas. In addition to that, those are ground-up builds with this Callaway Architect. I believe 3 of those have been with Callaway Architect. So that's the direct development experience that we have on the management team. In addition to that, I'll cover a little bit more detail in the team section, that last section of our briefing tonight, about what Callaway's experience is, what our builders that we're projecting to go with, what their experience is also. Okay, so if I haven't covered that in enough detail at that point, please readdress that with me so I can get to those points. Any other questions on this slide or on the strategy of this investment? Okay, and I appreciate that question, and I'll get back to it. Okay, let's look at the market of Maynard. Okay, we've already talked about strategy. Now let's talk about the market analysis. Here's Maynard. It's Austin's eastern frontier, as the map indicated, 12 miles outside. It's along a major highway, okay? And it's really poised to see some explosive growth because of what's happening in the Austin major metropolitan area. This is one of my favorite slides, and I want to tell this story. Why Grassdale? A lot of people ask me that. Well, read that story there. The guy who founded Maynard, James Maynard, he was a pretty good friend of Sam Houston and a lot of the other pioneers that founded Texas. And he was one of the instrumental people. It's just the city's namesake, okay? And obviously, he lived in that area, and he dedicated a lot of the land and gave it to the city. But if you read that last sentence there, he founded the city of Maynard, and he established the very first post office in 1859, and he called it the Grassdale. And so as we were looking at what our name was, we didn't want to just be another John Doe apartment complex. We wanted to tie it into the community and tie it into the area. And so we looked in this and we thought, hey, Grassdale, and that's going to be our marketing concept, and that's going to be the story and a lot of our marketing material behind Grassdale. So that's what we're trying to tie our marketing and tie our project into the community and make it more than just another project. That's the story behind why we call it the Grassdale. All right, this is what it looked like in the turn of the decade, and this is what it looks like now. This area right here is the major area or the smaller community of Maynard, and then this is where our site is located. You can see the residential development area that has occurred here. Population growth. In the turn of the century, or the turn right around 206, okay, they were right around 5,000. And these numbers are coming directly from the city of Maynard census. And right now we're just a little over 17,500 in the Maynard area and the surrounding. And you can see the projections that are occurring, okay, in the next couple of years. This is what the growth pattern looks like. You can see right around this step up, right around 2016, there was a population surge, and that was a result of completing the infrastructure in the highway area that occurred right around 2015. That allowed some of the single-family residential communities to develop, and that increased population growth. Now we're at 2019, and we've got the opportunity zones, and I suspect that as you see these grow, there will be another significant sharp incline, and then probably a stabilization to get to these numbers or get to the higher numbers. So that's the population growth. A lot of people moving to this area right around Maynard, a lot of people moving to the Austin area because of the job growth and because of the climate, taxation, and favorable business policies. This is the current development since October 2015. And the point to make here, here's the community of Maynard, here's Highway 290, and then here's our project. If I was to overlay the opportunity zone, everything south of Highway 290, and then on the east side of this road, and then on the north side of this road contains an opportunity zone. There's also one over here, but all of these areas are not opportunity zones, and they don't have the tax advantages that they offer. But you can just see there's 19 different developments that are currently in progress or that have recently been developed across this area. Okay.
Hey, Lane.
Yeah, go ahead.
Hey, can we just take a minute and make sure everybody out there has got a mic on mute? We've got an open mic, and it's pretty distracting. I think we had a late arrival, and I don't think they're aware that they are unmuted, so there's a lot of extraneous noise. Yeah. Everybody check your mics. Make sure you're muted.
Yeah, if you go down to the bottom of your screen, you should see a button that says mute. If you just click on that, that'll make sure that you can hear everybody and they can hear what's being discussed. Thank you. Okay, there's 19 different developments that are ongoing. A lot of these are single family developments. And then the thing to point out is there is no current multifamily projects that are in Maynard. There is one project that is multifamily, and it's a senior housing restricted development, and it's over in this Maynard Heights area. So there's no current multifamily, and you can see all of the single family residential areas that are developing as a result of that population surge in the city of Maynard. This is the new home permits that have been issued, and you can see pretty stable, right around that turn of the infrastructure improvement around 290 and 130. Okay, you can see a sharp increase, okay, and then a kind of a slightly level off here from 2017 to 2018. And this is just the beginning year, the beginning 2 months of 2019. So a very strong population surge in Maynard over the last 4 or 5 years, and they're expecting that to continue over the next couple years also. This is the commercial development that's occurred and some of the anchor stores that have moved into Maynard already. Okay, you can see these anchored national chains and where they're positioned. Right in this red area in the middle of your screen is a Walmart area that's recently developed there, and you've got some other areas of development right along the north part. Realize again, these are not opportunity zones. Our area is, and our plot is right here where the star indicates. Okay, right here. Apologize about that. My cursors indicate where the star, where our project is. Some significant things to point out. If you've ever heard of Maynard before, you may or may not, but it was in the news 5 or 6 years ago. President Obama came to Maynard and he went and visited the high school. It's called the Maynard New Technology High School over in this area. And he was able to visit that as well. There's also a golf course that's just to the north of the little area of the population too. So this is the commercial development that's occurred there. And another point to make is we're right here along Highway 290. This is our site. And we have 4 acres identified on the northern portion of our site as a retail center. So we would like to get one of these national retail chains to build out that beginning lots there. And we're going to be building in the southern portion of our lots. And I'll show you that on the site plan in just 1 second. But this is the commercial development that's occurred in Maynard, and it just shows the strength. Here's the sales tax. So you can see the commercial enterprises that have occurred in the city continue to rapidly increase. And over the last 8 years, there's been almost a $1 million increase in sales tax revenue. So there's quite a lot of industry going into this area, both commercial, both single family projects, and then now probably some multifamily projects, although we're the very first ones to lead out in this area. Let's look again, the major Austin metro area, a huge population, over 2 million. This is one of the leading top 10 technology centers in all of the nation. So many jobs are coming in here. Google campus just established a work area. We have a Samsung work area right off of Highway 290. And Austin, of course, is one of the fastest growing cities in the state of Texas. All right. What I've got here is I want to show you, the next slide is our rent comparables before I get into the actual property assessments. So what you've got here is this is a 2 million population density right around Austin. And Maynard is, just like I said, about 10 miles or 12 miles outside. And so we're going to drill down here in just 1 second. I'm going to show you all the multifamily projects and where they're located. So we're going to look at this map. This is an expansion of what we're going to look at next. And then these are the multifamily projects that have been developed since 2016. You can see there's 15 of them, and this was our basis for how we were able to determine where our rent structure is, and this is going to build into our finances for the project that we have ongoing. You can see what we've got is our project is right here, right along Highway 290, and the majority of these projects are lined up either on I-35 or on one of the major corridors, okay, that bracket the Maynard and the North Austin area. I've got these listed, there's 15 total, And you can see we're pretty much right in the middle of that pack. Okay, we're going to be one of the newer builds. Our average size is pretty much comparable to these other units. Our square foot on average is about the same amount, so we're right in the middle of that. And then you see our rents. The highest rent is $1,730, Project 9, closest to Austin, and the lowest is over here on Project 13, just off of I-35. So that's the rent structure. We feel like we can get to this point because, as you see, these sublying properties right here, the way to get to them would be go to Highway 290, turn north. You're going to be passing our project, and you have to drive and commute up there. I assume a lot of these people in Pflugerville and these outlying areas are probably commuters into the Austin area, and that's really kind of the tenant that we're expecting. Probably somebody that lives in Maynard and commutes along this way into the Austin or outlying Austin area. And so that's our rent structure, and this rent price on average, based on our square feet and based on the number of units, is the numbers that we're going to use for our pro forma and use for our financial calculations that I'll show you in the next couple of slides. But I think this is an important slide to kind of capture for a second. So I'm going to pause here for just 1 minute to let anyone that has a question about this ask, or any of the previous slides that you may have a question about. If I've gone a little bit too fast or you'd like to go back, I'm going to pause here before I stop talking about the market and I start talking about the projects. So a quick pause. If you have a question, then please sing out. Take yourself off mute and please let me know.
Hey, Lane, this is Rich. Just a comment for everyone, and just to reiterate, that one multifamily property called Silver Creek is not even built yet. It is permitted, or they're in process of being permitted. But for such a burgeoning area such as Maynard, there is, believe it or not one multifamily development there. So there may be some concerns over the fact that Maynard is on the outskirts of Austin. However, there's just a tremendous amount of population headed out that way. And with no other multifamily assets available in comparison to the single family developments that are going in everywhere, we believe that the demand is going to be there, and it's right really on the market average of what all those other properties are bringing in.
You can see these single family developments that Rich was talking about, and just a lack of multifamily. And that's why, that's another good point to mention, is because a lot of people have said, well, Lane, are you going to have any concerns about getting city approval for your project? And the answer is no. They're very, very excited about our project because they do not have any multifamily communities. And so they know that they're going to need a space to grow, and they're really encouraging our multifamily. So obviously we're going to work with the city to get that approved, but they're very cooperative and have been very cooperative in our, we've probably had 4 or 5 meetings with them already to make sure that our project is going to go forward. And we expect it. Good question. Are there any other questions or comments, Michael? Did I miss anything so far about these as I go back to our last slide on market analysis?
And this is Cheryl Leonard. I want to interesting that Maynard is really only 13.9 miles from the airport for Austin. And if you were living in Cedar Park or even Dripping Springs is more comparable to that distance to the Austin airport. I think that that's a good point to bring up.
Yeah, Austin, Bergstrom is right here. So there's the airport too. You can see the accessibility along I-30 or along Highway 130. And I think this is a very important part of the development of Maynard, is just the infrastructure. And you can see how easily commutable it is. And certainly now with the congestion, if you've driven in the Austin area, I-35 is just sometimes impassable with so much congestion. I-290 and 130 is probably one of the preferred ways to get around Austin or to commute in and out of Austin. You can see how close we are to that. The majority of what I showed you before is right up in here, okay, and it's also on here. So you're going to be driving past Maynard basically to turn north to get to that. Okay.
Hey, Lane, I want to make one more. I want to make one more shout out to area code 469-360-7742. They're muting and unmuting their mic, and I just want to make sure that they would mute that so that it's not so distracting for everyone.
Please mute yourself if you can. That way it'll give us a chance to make sure everything's heard. Okay, that's the last of our market study. And Michael, I haven't heard you chime in. Anything, I know you did a lot of work on this market study. Anything that I haven't already mentioned that's worth mentioning, Michael?
Yes, Lane. One thing to consider is Manor has had a challenge with utility availability, and they are really opening it up at this time. So we're starting to see more and more sites now have the opportunity to be developed. That has not been the case in prior years. So while development has gone north up through Georgetown, Round Rock, and then has headed east, we think that Manor is just set to explode. So even the census data that you showed, the predictions were very conservative. We think that Manor is going to grow even more than that in the next 3 to 4 years.
Good point. Okay, that's going to conclude our market survey and our market analysis. Let's move on now to the project analysis and talk a little bit about the details and about the finances of that.
Hey, Lane, there's some questions on the chat if you want to address that.
Yeah, Michael, would you mind to read the chat to me? I didn't get, it's hard for me to navigate all these different screens. Would you mind to read that to me, or whoever can help me with that, please?
Yeah, the first question is the property going to be on the tollway? And no, it's not on State Highway 130, but it's about probably about 5 miles east of that.
I believe the tollway stops at about where my cursors are right now. So Highway 290 is a toll and Highway 130 is a toll. To the east of where my cursors currently are, this is a state highway and it's not tolled.
And the next question, Lane, and Michael, you may know this, is there any public transit or plan for it in the future?
Yeah, that's a great question.
There is not any current mass transit. There has been discussion about future, but it's still a discussion at this point.
Yeah, and there's been a good discussion about a rail line that connects Maynard to downtown Austin, but that has not yet been developed or approved. Any other questions off the chat? Rich, can you help me monitor that? I don't have all that capability here without losing my point. Okay, let's talk about the finances of the project. Property analysis. These are the investor highlights. The description, like we've already mentioned, 320 unit situated on 19 acres in Maynard. And the 4 acres, as you can see here on the northern portion, are going to be retail space. This is what the property looks like. It's about 40% 1 bedroom, 40% 2 bedroom, and then 10% or 15%, a little more than 15% 3 bedroom. We're going to have 100 covered garages, and some of those will be carports, and a combination of carports and garages, and 2 and 3 story elevations, as you can see here. So that's kind of the general sketch and the layout of how the project turns about. Financing. Our total project cost is just short of $47 million. We're organizing HUD 221D4 financing. This is a $33 million loan at just under 5%, and it's going to roughly equate to about 70% loan to cost, or a little bit less than that. The good part about this is it's a 40-year term, okay, with our 40-year amortization, with a it's a construction loan, permanent loan as well. So there is no refinance point anywhere if we're approved by this financing period. So that makes this a long-term project with secured, attractive debt that we don't have to worry about what's the market going to be like in 3 to 4 years as we refinance from our bridge loan or our construction loan into permanent financing. If we can get this arranged, we have permanent financing from day one, which helps secure a stable future going forward. This is the Gold Star financing, and we're expecting to get this. They're very favorable right now for our project in this area, and we're expecting to get the approval in the next 2 weeks on our HUD financing. But that's the HUD in situation. The cash flow, okay, cash flow from operations, we're calculating at $16.6 million, and the total proceeds, 61.9%. That gives us a 10-year return on cash of 356 and an equity multiple of 4.5. So that basically means the equity multiple, the way that's calculated, because that's kind of an unusual number, is your total cash distributions divided by your total equity. So anything greater than one or anything less than one means you get back less than $1 for every dollar you've contributed. And anything over that basically means for every $1 that you contribute, you get $4.5 back. And it's also an idea of your leverage as well. So that's kind of what that number means. And we're going to use that number a little bit more, but that's what you can expect at the end of the 10-year hold period. The tax benefits. This is an opportunity zone. So if you qualify for opportunity zone reinvested capital gains, and what that means to you is you sell a capital asset, and within 180 days, you contribute that money into a qualified opportunity fund, which is what we have. We make sure we're compliant with it. Then at the proceeds at the 10-year sale, you will save, okay, $40 million. The 7-year capital gains savings on the equity that you would have paid, $485,000. The capital gains savings on that sale, $9.5 million. And the total, so if I add this number and this number, the total tax savings as for this project will be $10 million. And that's assuming that you have a 23.8 capital gains. Now, I kind of went over that fast, and there's probably a lot of questions potentially that how did I come up with this number? And it's probably best if you look at our website, because we have a very detailed video explanation of exactly how those numbers are calculated. But the bottom line is just like I mentioned to you before, you're able to, if you invest your money now with us with capital gains reinvested, you're able to defer that tax payment, you're able to decrease it, and then you're also able to exempt the profits on existing inflation or appreciation.
Hey, Lane, I was going to piggyback onto what you said. In case anybody's a little bit confused by that, if you look under the second category under the subtitle finance, where it says equity required, the tax benefits numbers are all predicated on a starting point of 13.6 million. Obviously, there's no way to predict how many investors are going to be bringing capital gains, what the IRS refers to as eligible capital. And some people will be bringing just unencumbered capital or post-tax capital. But just for the purposes of this analysis, assuming that every penny of equity raised was capital gains or eligible capital that was reinvested into the program, and assuming that those were fully invested with 7 years before the step up in basis, what happens is after 7 years of being fully invested, that's when the deferment of the capital gains tax must be paid to the Treasury. There is a step up in basis, and the discussion of how that works is beyond the scope of this presentation. Like Lane says, it's addressed in detail on the website, but suffice it to say that not only is your tax liability reduced by roughly 15%, but you're also going to be paying those taxes in dollars that are devalued over 7 years. Now, as that investment continues to grow and is held through 10 years, and then you have the proceeds at a 10-year sale of $40 million with no taxes owed on that amount, you have a total tax savings of $10 million. So now that you've received a second confusing explanation of how that works, again, I just want to piggyback with what Lane says. It is a somewhat of a nuanced concept that's brand new, coming out of the Tax Cuts and Jobs Act of 2017. We have a couple of very detailed videos on the website under the project tab that explains in more detail what a qualified opportunity zone is, what a qualified opportunity fund is, and then what the tax benefits are of investing in a qualified opportunity fund. So I know that those numbers in our verbal only explanation without a visual can be a little bit dizzying, but if you watch those videos with the visuals, it should clear those up for you. But suffice it to say, the tax incentives coupled with this leveraged HUD multifamily property in a burgeoning area is a pretty explosive opportunity.
Thanks, Rich. Okay, let's continue into this area as well. So what I'm going to show you over the next 4 slides is a whole lot of numbers, and I'm just going to highlight a couple. I'm going to send you these slides back so that you can really dig through this. And if there's any question about what this means or explain this some more, I'll be glad to answer that, and you can reach back to me. Now, before I show you the next couple slides, I'm going to make the note of what Rich just said. The things I'm showing you right now pertain to any dollar invested. The advantages of the opportunity zone leverage and accelerate everything I'm going to show you. But whether you invest with recapitalized or reinvested capital gains or an ordinary gain, this number applies to you. Okay, so what I've got up here, I know this is a little difficult to see, but this is our budget for how we're getting the total project cost. And just a couple things to point out as highlights only, because there's a lot of things that we could get into a discussion about. The land is costing us $2.85 million. The building cost $35.9 million. Okay, that's a total of $43.4 million. And then we have a whole lot of financing fees, interest expenses, and period taxes. That gives us a dollar value of $46.7 million, and that's what we're using to calculate it. If you want to go back and study this, here's a per cost net rentable square feet per cost per unit. Okay, and you can see the construction cost per unit right around $112,000, and we've already vetted these numbers through the builder and through multiple builders, and they said, yeah, we think this is the number that we can hit at this point. So that's our budget. I'm going to send this to you. You can study it a little bit more and reach back to me if you have any specific questions on this. Okay, next slide. This one I'm going to stall just a little bit. This is probably the best slide that encompasses the whole project. And so I'm just going to allow you to look at this for just 1 second. Again, I'm going to be sending you this so you can look at it in more detail and make a good decision. To start with, the strengths of this project, it's a high quality investment leveraged in a tax incentive opportunity zone. It's in an emerging market, the top 10 technology centers and fastest growing area of Texas, well positioned. That traffic counts 70,000 vehicles per day. Value add with a 1.3 spread, I'll explain that. Attractive partner returns over the holding year, and permanent financing with a 40-year amortization. What are the weaknesses? Is this is a rural area in a maturing market and an expanding population. So we need that to continue to mature, and we need that population to continue to expand, which is what we hope and we think it will. There's really no competitive property in Maynard that we can bounce our income and expenses off of, but we're using those properties in the close proximity, and we kind of have that field of dreams. If you build it, they will come, and we hope they will, and we suspect that they will. And then, like I said, the financial returns depend on the improving demographic and the market trends. So those are the identified weaknesses and the identified strengths that we've already alluded to. This is the investment description. I believe I've covered this in detail already. So I'm just going to pause there for just 1 second as you review that upper left column, and then I'll kind of go from left to right to explain some of these things and why I think it's a good investment opportunity. Okay, sale date and 10 years from our acquisition date. Rental and growth rates, okay, you have here, you have our $1.53 per effective rent. You know where I got that number from. At the point of stabilization, we're expecting a 5% vacancy, okay? Our operating expenses are gonna be 35% of our gross potential revenue. Our break-even occupancy, okay, once we're stabilized, 58%. So we can run this at 42% vacant and still break even. So that's a very low or a very unexpected number, and that gives us a margin for error that makes the project comfortable. The sale proceeds after the sale cost, $92 million. Woo, can I get an amen on that, please? We're buying for 47, selling it after that, and then the loan payoff. So the equity proceeds from sale in 10 years from now, just shy of $60 million if we're able to achieve these performance things. So there's a lot of upside in this project, and this is a number whether you use capital gain reinvested or you have ordinary gains. And the significant part of that is if you're using capital gains reinvested, this number comes back to you with no capital gains benefit or no capital gains liability. Here's where we're going to source the debt, capital partners, sponsors, okay? And it says here right here 135, but I know that our sponsor pool is going to put in probably about $3 million, but this specific spreadsheet doesn't allow you to do that. So our capital partners or our sponsor partners who are putting in about $3 million default to this category. So just to let you know, our leadership team is trying to put that amount together, although it's not reflected accurately here because of the limitations of the software. Total sources, that's where they are. Okay, that's the key assumptions. Let's look at this pro forma on how we're expected to do. Okay, the gross revenue at the point of sale, just shy of 7 million. We have a net operating income just right at 4.6 million. Cash flow, okay, our cap rate we're projecting at 5%. So we have a valuation at the time of sale, $93 million. And you can see these numbers. Here's where our numbers break out. So we're all in at 46. We're going to sell 10 years later for 50, for 93. And that's kind of how we've broken that out. Let's look over here for what the returns are, okay? Your capital partners, they're going to get a 381% return on investment with an equity multiple of 4.825 and an internal rate of return 21.3. So that means for every dollar you give me, I'm going to give you back $4.82. Overall return should be about 381% over 10 years. Divide that by 10, and you've got about a 38% annualized return. That will equate to a 21% IRR. I make note of this, the sponsors' numbers are just skewed really high. And the reason that I said that is because this number's so low. And like I said, the sponsors intend to put in about 3 million. The sponsors are your leadership team, myself, and the other guys I've introduced. But that number, because of the software limitations, goes into the capital partner. So it's not really calculated correctly. The property returns, the rate, the return on investment with a levered 460 with an IRR of 23.4. And then the developmental returns, the yield on cost, the market cap rate. And let me explain this because this will be a little important as I talk about defensive strategy. And I know this may be a little cumbersome. So the cost, the yield on cost is the advantage that you get from the, how that's calculated is it's the first year of stabilized net operating income divided by project cost. Okay, so you're looking at what you're going to have the stabilized NOI on the first year of stabilization, and you're comparing that to the purchase cost if you were to buy it on the open market. So what we're going to look at here in the next couple of slides, and this will help you understand, is that spread. So the spread between what we could buy it for and what we can build it for is 2.32. Okay, and then at the date of sale, it's 4.97. So it's 5% better that we can get if we build it versus if we were to buy it. So that's how that spread works. The higher the number here on basis points, the better it is to develop the project. So you can see in this case, the untrended and then the sale point, you still got almost 2.3% better. You're going to get more money on developing it than you're going to get on the cap rate, okay, or on building it. I'm sorry, on buying it. So I'm going to stop there for just 1 second. I've covered a lot of material on this particular summary, and I've got about 3 other slides. They're not as detailed as this one is, but I just wanted to stop there and ask if there's any questions or if there's anything in the chat box that comes up as a question. Okay, and I'll be sending this to you also so that you can dig into this and look at it more, ask your accountant, ask your investment advisor to go over these numbers with you, and you can call me and I'll be glad to answer that. We're going to go on to the next page now.
Hey, Lane, we got one question from the chat box.
Okay.
Is break-even occupancy after or before debt service?
That's a good question, and I don't know the answer to that. I believe that is an after debt service break-even point.
It is.
Okay, yeah, that's what it is. So we can, this is a defensive strategy, and I'm going to cover this in just a little bit more, but that 60% occupancy, as long as we're at that point, then we're going to be able to hold the property and break even. Any other questions from the chat box? Okay, next slide then. Okay, here is a project cost by month. You can see the majority of the cost is right around here in the build cycle, and then our costs obviously go down quite a bit. How does the equity and the cash flow return? Well, the very first portion all goes to repaying debt, and then you can see as this grows, it begins to stack up against that preferred return in the beginning years, and this is all in the construction years. That correlates to our operating income, and as you can see, as we get into our project, right now we're at month 0. Okay, we're going to break ground at month 9, and then right around the 1 year point is where we begin to run the project and operate it, with the very first units coming on board about 1 year. And then you can see that the operating income as we lease up completes at about the 33, 34 month is where we reach stabilization. So from the very first project delivered, about the 14th month, about 20 months later is where we're expecting that 95% occupancy. Year 1, we're projecting 55% occupancy across that, year 2. And then year 3, we're averaging 75% occupancy. And then as we get past that, we're at the 95% occupancy. That's our net operating income. I've already covered these 2 topics. And then this shows us in this column, okay, that we're better off yield on cost. In other words, what our cost to build versus cost to buy, we're better off in all categories, untrended, trended, and to sale point, we're better off with a higher development spread between the cost of building versus the cost of buying by that many percentage points. A lot covered on this slide, I know that, and I know that it's a little bit hard to chew into, but I'm going to send it to you. Are there any questions on this slide? Okay, the next slide is the cash flow slide. Okay, again, a lot here. I'm going to send this to you, but this is the analysis by years over the 10-year hold point, 0 year, all the way across to year 10, and that's going to be May 2029. So you see our development cash flows work out mainly in year 1, 2, and 3, and then we transition from development into operations, and that's where our cash flow comes in. Rental income, vacancy loss, and credit loss okay, begin to stabilize into post year 2. Okay, and then you can see our operating expenses, and these play out to about 40% of our gross potential rent. Okay, and then our net operating income. So year 0, we're in construction. Year 1, we're in construction. Year 2, we're halfway through construction. And then year 3, we're going into our final portion of construction and lease up. And then that's when these numbers get really attractable. So we've got an NOI here that develops and gives us the operational cash flow. So we're expecting to break that point where we're returning our first distribution right around the fall timeframe of 2021 is where we're starting to pay that first distribution off, or the summer timeframe of 2021. So about a 2-year point or 18-month point will you be getting your first cash distribution. Over the course of 10 years, we're expecting an average of 11% cash on cash return, and that number escalates, as you can see, in the out years as we get more income and we stabilize the project. So that's our cash flow. Again, I'll be sending this to you that you can review in more detail, and you can probably see a little clearer than what I can show you on the screen.
Lane, if I could interject something here.
Yes, go right ahead, Michael.
On the very bottom of your screen, the spreadsheet is cut off. It doesn't show debt service. So actually in that year 2, it's has an operating loss because of debt service, but HUD requires a holdback for that. So cash flow really starts in year 3,
Okay.
which is not reflected on this.
Thank you, Michael. Anything else to point out, Michael, on this slide or the previous one that I may have gone too fast for you?
No, I think that's good.
Okay. Any other investor comments or questions that I haven't already addressed? Okay, good. I think there's just one more financial slide. Oh, here's the stress test.
Lane, I got one more question in the chat box. If I understand correctly, opportunity zones were created to revitalize distressed communities. Why was Manor considered distressed? Seems like it's on a solid pathway as Austin grows. And I'll field that question since that's an easy one. We've often chatted amongst ourselves that all opportunity zones are not created equal.
Mm-hmm.
There are many opportunity zones that are in blighted or run down, very old communities that might be regarded as ghetto or bad neighborhoods. And you're exactly right. And that's also why we decided to jump on this very, very early. Lane and Michael were very aggressive about getting down and combing opportunity zones that looked very, very promising. Austin being one of the fastest growing cities in the country. And, I personally, I drive through Manor on a weekly basis, and I will tell you that the development there and the traffic is staggering. TxDOT is up and down 290. They're already widening it. They're putting in utilities. The number of national brands and building development going in there is staggering. And so you bring up a very good point. Consider yourself lucky to be a part of it. That's my answer.
Mike, I think you had a question too. There was another question. If you'll just take yourself off mute and sing it out.
Hey, can you hear me, Lane?
Yeah.
Okay. I just had a question about the distributions. I mean, these distributions from your rental cash flow are taxable to the recipient. And I just wanted to know what your thoughts are in terms of, you're going to have this debt, it's long-term debt, and you're not planning on refinancing that. But it would just seem to me that just purely from a tax advantage, wouldn't it behoove you on, at least from a tax perspective, to more aggressively pay down the debt, even in excess of what is required monthly? Because the distributions are taxable, but at the end of the holding period, when you go to sell, you're not taxed. So in some sense, you're trading taxable distributions for a tax-free cap gain at the end. Do you have any thoughts on that?
I do, Mike. So that's a great question. So what we're going to do is we're going to use another tax advantaged allowance of the IRS, which is going to be the bonus depreciation. And so what we're able to do is we're able to classify real property from personal property, and then we're able to take all of that depreciation and accelerate it into the beginning portion of operations. And believe it or not, the first year you can accelerate all those by the benefits, the tax benefits that were imposed by the government in 2017, and you can accelerate those losses into the first year. And so what we'll do is we will do a cost segregation study and accelerated depreciation. And instead of straight line depreciation, we'll accelerate it, and then we'll push a lot of that loss into the beginning years. And what that will allow you to do, Mike, is it will offset your distributions with passive losses, because that's a passive gain or passive income. And you'll be able to take that income essentially tax-free or tax offset by the losses of depreciation. Now, normally you have depreciation recapture when you sell the project with capital gains, but if you invest the right dollars, then you don't pay capital gains on that. So I understand what you're asking, but there's another strategy that we're going to implement, and that bonus and accelerated depreciation will hopefully exempt those distributions that you're receiving in the first 10 years, or a large majority of that. Did that answer your question, Mike?
Yeah, I think that answers my question. I guess, I guess it really depends on what the depreciation numbers end up being. And at the end of the day, you'll only know that when you get there. Yeah. But if you did have gains that were in excess of depreciation, that you could bank that, you'd be better served to bank that, at least from a tax perspective, by paying the debt down more aggressively rather than giving it to distribution. Yeah. I don't know. I mean, you did answer the question though.
And Mike, we did a preliminary study. You can normally accelerate like 25 to 35% of the project cost into the first year depreciation. And we made an estimate, and we didn't do this, but we'd use a tax engineering service to do this estimate for us. And believe it or not, the first year of operational accelerated depreciation was a $10 million loss. And so you're going to have a tremendous paper loss that you will be able to bank year over year until those distributions exceed $10 million. And that may carry you through a large portion of that. That's a very complicated subject, and I know there's a lot of nuances to that, but we have another strategy to help offset that ordinary distributions and the tax ramifications from that, which I think is better than what you suggested with paying down debt, because it'll free us up a little bit more in cash flow. So, Michael, did I answer that question correctly? Is there anything you want to add to the engineering tax study on that?
No, I think you're absolutely correct.
Okay.
Yeah, the other thing, Mike, is the Treasury is in the process of writing new regulations, even as we speak. And in fact, we're all going to be attending Opportunity Zone Conference later this month, because Treasury has released the second tranche of regulatory guidance on that. There is some anticipation that there is going to be some restrictions on the typical income distributions that Lane's talking about on normal business operations, because these Opportunity Zone investments are not limited to real estate investments. They also extend to business operations as well. And so the intent is to spur economic activity, but not choke off tax revenue for the authorities, much to our chagrin. So my anticipation is that the strategy that you are speaking of about, for lack of a better term, squirreling away all the profits and paying down the debt, I think there is going to be some regulatory guidelines that preclude that. But we're going to find out more about that in the coming months, because the regulatory scheme is being developed even as we speak. And with that, Lane, there's two more questions that just popped up in the chat. The first one from John John Hancock, it was said the front part of the property would be commercial. The whole property is commercial, but I think I know what you mean. It's going to be more like a retail. And he asked, are you planning on leasing that land or selling it? If either, do those numbers show up in the cash flow shown here? And I think,
Yeah.
Michael, you know that for sure.
Yeah, Michael, you want to address that?
On the screen you're looking at right now, there is no income showing up for the retail portion at all.
Yeah.
We have met with local retail experts, and we originally wanted to have ground lease on the out parcels in front. Experts are telling us that's a little bit farther down the road than Maynard can support right now. But, you know, we have left the 4 acres alone to allow for us to either sell and put back into the development or to ground lease it. So.
And the other point to add to what Michael said is the city is very enthusiastic about making that front part of the project retail space. So they really want us to do that, and we feel like it's going to be a good benefit. And we're looking probably, we initially thought that, you know, immediately somebody would want to come in there with a high quality retail. But what Michael is referring to is the investor said, well, that's probably 3 to 4 years away. So we're holding that out of the income stream and revenue stream, but that's going to be an extra whipped cream on top of our sundae when we get that as well. Good question. Well, there was another question.
Yeah, next question from Hank. It says, I know this is an unlikely scenario, but should there is a need for a cash call, do you have any plan for this? Should there be a need for a cash call, is there a plan for this? That Lane's about to discuss the various stress tests, and you're going to see that that's pretty unlikely, but I would think that just like any adverse situation where there's a cash call, I mean, that's obviously,
yeah.
It's.
Let me go over that in the next slides, and then I'll wrap that up at the last slide, okay, and cover that point. So this was the cash flow. I'm going to send this to you like I've already mentioned before. So now let's look at, in the next 10 years, I can guarantee you there's going to be some turn in our economy, or maybe a plateau, or maybe even a downturn. So we really need to think about how we're going to be. This number that I have here is an offensive game plan, but we need to think about the defensive game plan, because over the next 10 years, who knows what it's going to be and how are we going to protect this investment, because it is a 10-year investment. So let's go over the stress test. How have we, I showed you the best case scenario, or what we think is optimistic case. Now let's talk about worst case, or let's talk about defense. This very first slide here is a stress test. In other words, we're really putting some stress on the property. Right now, we've got it running at 95% occupancy. In other words, 5% vacancy. And that tells me that I'm 5% better developing than I am buying on the open market if I can maintain a 5% occupancy. And that gives me a $5.60 or 5.6 levered equity multiple if I can maintain that. Okay, so I'm going to just pause there for just 1 second and let you absorb that. Okay, 5% better to build than it is to buy, $5 or 5.6 levered equity multiple. In other words, for every dollar you give me, if I can hit that number, you get 560 back at the end of the year. Now let's go down. Now we're at 92%. Okay, you see the number. Now we're at 90% occupancy. We have 10% vacancy. Now we're at 88%. Now we're at 85%. Now we come all the way down here to 80% occupancy. Okay, that's not a good point to be. Okay, but even in this worst case that I've got designed here, 80% occupancy, we're still 2.67 basis points above what we could buy it for. So this is a very healthy number still, and we're at 80% occupancy. And for every dollar that we run the project at, you're going to get back $3.52 at the whole point. So what this says, I know that's a lot of numbers and a lot of mathematical formulas that may not be completely familiar to you, but this is a pretty safe margin considering that we're expecting to be better than 80% occupancy. Okay, that's stress test 1. Stress test 2, okay, this is our exit cap, okay? So now we're expecting the project to be an exit cap of 5%, okay? At 5% exit cap, we're gonna buy it at 5, we're gonna exit at 5, okay? Then we're gonna have a 5% advantage from building versus buying. So it's to our advantage, okay, to build than it is to buy, 5.660. Let's say this exit cap starts going up. And it goes up by a quarter of a point, half a point, 1.5 point, and then all the way here to 7. So we're gonna buy it at 7 cap, and let's say we had to sell it at we bought it at 5, we have to sell it at a 7 cap, where we're still 3 percentage points or 2.98 percentage points better off than if we were to have bought it at the same cap rate, which is 5%, and we have a 3.6% equity. So again, even if the backside of our project doesn't bloom like we want it to, we can still allow some stress there. Let's say the market at the point where we try to sell it is not as advantageous as it is now, we're still going to be in a good situation. Normally this number about 125 or so is kind of where you're thinking, well, the development risk versus the return starts to neutralize, but you can still see that we're over that number with a little bit of margin. So that's stress test 2. On the backside, the market's not good when we try to sell it. What are we going to do? We're still in pretty good shape. Stress test number 3, okay? I'm sorry. Okay, is now the income, now our rents, okay? We're projecting 3.5% rent growth year over year over year. And we're doing that because you saw the population increase. You saw that the development areas around Maynard, okay? And so we're expecting this to be a little bit better than the national average. But let's say that doesn't happen. Let's say that instead of 3.5 percentage, it only goes to 3 or maybe 2.5, or down in this worst case, it reverses and we start losing ground and we have to give rent concessions up. And now we go all the way to 3, okay? So this is where we begin to see a big drop off. So not only can we get that 1062 rent, which is what we were counting for, let's say we have to get 940 rent or 920 rents and we're projecting a 962, well, that's where we begin to break even on that point. So if we dropped our rent price by 4.5%, then we're probably at the break even point. Okay, so that would be a rent growth rate decreased by 4.5%, and that's what this reflects. So you can see if we had to drop it all the way by 3.5 plus 3, 6.5%, then we're better off buying at this point. But we suspect, okay, this increased growth will occur. Why do I say that? Is because if you look back at the number of development opportunities, the number of multifamily projects, and also the development area and job growth, I feel confident that we'll stay above the 2 number. We'll have a 2% growth, okay, and then we'll have, again, a very healthy development spread. All right, the last one, then I'll stop for questions, okay, is our expenses. Let's say now that we tried to operate this at 39% of gross projected rent, and now we're having to operate a lot higher. So it's costing us, the expenses are a lot higher. We're projecting the growth of 2.5, but let's say it gets a lot more expensive to build and operate in Maynard. It goes to 3, 3.5, 4, a 5% expense growth, now all the way to a 6% expense growth. You can see those numbers, because they're already relatively low because we're building a brand new project, those increase, but they don't have quite the dramatic impact and still very healthy as the previous stress test over here in income. So as long as we can get our rents, okay, you can see these numbers pan out pretty well, and it's to our advantage on the development spread to develop the project versus if we were to buy this existing project brand new today, we'd be better off building it than we would be buying it, as long as we can get those rents of what we're pro formaing. And I've already showed you what statistics I've used to do that. Okay, so that's our stress test and what I like to refer to as the defensive strategy for this project, because we're going to hold this project for 10 years. We have an attractive financing already established, and now we've even stressed it to the point of breaking to some degree, and we still have a good development project that beats a good purchase as this existing property project. So that's why I'm confident that that this is a good investment, and it's a good market. It's the right project, the right market, the right team at the right time, and that's the project summary. Okay, Michael, what did I miss on all of that?
I think you covered it, Lane. We worked stress tests backwards and forwards just to make sure where we thought our break-even point was. We feel very confident in it. Some people are nervous and say 3.5% renting growth, but it's really just a 1% spread above our expenses. You know, we don't expect our expenses to grow 2.5%, but we do expect our income to grow 1% over our expenses, if that makes sense.
Are there any other questions about this before I go to the team portion of it? We've talked a lot about this numbers. These are a lot of numbers, and they're very sometimes difficult just to gather, but I'm going to send this to you so you'll be able to dig through it and ask me questions as well. But are there any questions that I can answer at this time before we go and talk about the team and the experience? That was a previous question as well. Any chat box questions? Okay, very good. The last topic is the team, and then we'll break up here. It's right around 7:20 right now, so we're a little over what I expected. But here's the team, okay, and just talk real quickly about the strengths that each team member brings to this operation, okay? That's me right there. I've got 28 years of investment, or 28 years in the Air Force as an Air Force leader, executing missions, managing projects. I was a squadron operations officer that controlled about 200 people, a liaison between two functions that operated a budget of about $50 million. So I've got a lot of management experience and got a lot of leadership experience as well. That's Rich. Rich is very instrumental in leadership. He's an airlines captain for United Airlines, so a tremendous amount of real-time combat leadership, tested under fire, and making missions successful with limited resources. So a lot of leadership on this side. This is Edwin. So Edwin's got about 20 years of operational experience in apartment complexes, maintenance, repair, renovations, rehab, construction expert in every area. Rodolfo has the same level of background with experience, and I'm just hesitant to say how many projects they have repaired, renovated, maintained, operated, upgraded, improved. And so remember on this project that this is a development project with 1 or 2 years of development, and it's also an operational project. So for the next 7 or 8 years after we develop it, we're going to turn it over to our operational experts, which include the right side. And Michael in the middle there is the heart of the program. He's got 4 projects, ground up development under his belt. So he does have development experience, but the majority of his experience is in property management, and he has a very extensive background in that. I think he said he purchased 48 existing multifamily. He's developed and worked with 1,500 different units or 1,600 units, and he has 24 major renovations under his belt. So extensive background in development, or extensive background in property management, maintenance, construction, leadership, and some development experience as well. Let me go to the other partners that we have outside of our management team, okay? And these are our Department of Housing and Urban Housing, HUD, okay? We're working with Doherty Mortgage to make sure they're in position, and we're working with Commensurate Bank as well. Here's our architect firm, our engineering firm, our builders, our strategic construction in Franklin, and we've got bids out to both of these corporation. Strategic is one of 4 companies in Texas that's in the preferred HUD development. Strategic has developed 20 properties in the last 18 months through the HUD program, the HUD or the HUD 221 D4 program. And so they're very, very knowledgeable and experienced in this area. And the same with Franklin, just a little bit less experience with Franklin, and they're giving us a bid as well. So all of these partners in the middle here, which are going to be the people that swing the hammer, the people that pour the concrete, these are going to be the lenders. Extensive amount of development experience, extensive amount of engineering background, architectural experience in the HUD regime as well. So we feel like that's a safe bet. And then for the operational point, we have Walker Holder Residential, an extensive 20-year background of managing properties across the country and mainly in Texas in the southern portion. And then we have our integrated management system to help us with our investor portal. And that's our team, okay? And I think that I answered the previous question about who has development experience and put that kind of package together. But I don't know if I didn't see who that was that asked me that question. If I hadn't completely satisfied that, I tried to the very best of my ability to answer that question. If there are any other questions about our team, then please unmute yourself and ask me, or chat box and ask me. Or if there are any other questions that include this presentation, this is the last slide that I have for our presentation tonight. So just open to any general questions as well for myself or any of the other management members on the team tonight. All right, over to you guys. Okay, I don't think, are there any other chat box questions that we didn't get to?
Yeah, Lane, there's a question here. What is the min-max amount for investment? And what is the carried interest percent for the sponsor group?
Yeah, good point. So the minimum investment is $50,000 accredited investor, and the maximum amount is there is no maximum. I want to make sure that everybody can communicate with me. If you're going to put a large amount in and you're going to use your capital gains, make sure that I understand what that is so that I can reserve your spot. The last thing I want to do is get filled with our subscriptions, and then I don't know about your pledge or your commitment. You sell an asset, maybe not unexpectedly, but you sell with the intention of reinvesting that and preserving your capital, and now I don't know about it. And that amount that you have intended has some unfortunate tax consequences. So there is no maximum, but you do have to be aware of the capital gains requirements and being able to understand that. The best way to do that is to contact me specifically, and also look at our educational videos that explain exactly how to transition that capital from one to the next. So I think that answered the question on minimum and maximum. And the other part of that question B was, what is the sponsor carry? So the way that works is you have a preferred 6% interest. So you always get, or as a capital investor, which I'm going to be myself, we're going to get 100% of all cash flow until we have a 6% return of our equity. Once we exceed that hurdle, then the remaining cash flow will be split 80% to the capital partners, 20% to the sponsors. And that continues in perpetuity until we sell the project. When we sell the project, you get back your initial equity that you've contributed. So if you contributed $100,000, that's repaid to you. Everything past that is split 80-20 in the same profit sharing arrangement. So that's how that is worked, and the carried interest.
Elaine, there was a subsequent question that just came in, but I think you just answered it. What are the investor sponsor split hurdles after 6%? And that's it. It stops right there.
There's just one hurdle. Once we achieve 6%, it's a profit sharing of 80-20 on all profits above that. And then you get your full equity return at the point of sale. Any other questions tonight?
Is there a development fee?
There is a 3% development fee that goes along with the project. And you can see all of our fees in the middle of the slide presentation. There's a budget, and you can see where those fees are, and you can see exactly what they are. And I'm going to send that to you. I know that was a little unfair to ask you to look or expect you to look at that, but the development fee is 3%. Well, if that doesn't have any other questions, I certainly appreciate your participation tonight. I think this is a fantastic project, and I'm very, very excited about it. And I think that this is really going to be something that you should be looking at, especially if you have some capital gains that are coming due or that have been sold. Remember, you have a 180-day window from the point of selling to the point of reinvestment on those capital gains. And the other point is, if you have some languishing investments, stocks, bonds, business equipment, other real estate, land that you would like to sell, this is the time to do it. This is the market to do it. This is the project to do it. This is the team to do it. Okay, so let me summarize and close with these statements. Okay, the right project, the right team, the right market, the right asset, and it's time to make it happen right now and help you become a better millionaire. I appreciate y'all's attendance tonight. I'm going to send this back out to you, the link to this webinar, and then the slideshow. If you have any question about it, please reach back to me, and I'll be glad to go over it in any detail to answer any question you have. Thank you, and I appreciate your time tonight. Good night.
Thank you.